Hello, in this video we'll be talking about property dividends and stock dividends. What are dividends? Dividends are the distribution of assets made by the company to the shareholders on its earnings. So we have learned in the past about cash dividends in a different video. When the company pays out from its earnings, they pay cash out as a dividend. A dividend can also be an asset that they have on their books that they can also pay out as a dividend. And so a dividend is really the management is returning to shareholders a portion of their investments. A company doesn't have a legal liability to declare a dividend, but once it's declared, then they legally have to pay it out. There are different types of dividends. There's a cash dividend, and we've talked about this in a prior video about cash dividend on common stock versus preferred stock. And then there's two other types of dividends that a company can pay out to its shareholders. They can pay a dividend out in the form of property or the form of additional stock in that company. Let's talk about property dividends. So first, like it's indicated, the property dividend is an asset that is paid out as a dividend that's not cash. It's a non-cash asset. It's sometimes called a dividend in kind or non-reciprocal transfers to owners. And usually these property dividends that are paid out or distributed, I should say, are investments that the company has in other companies. So if Apple pays out, they don't, but let's just say Apple paid out property dividend and they have stock in Meta, then they could distribute their stock in Meta as a property dividend. What amount should those property dividends be recorded at? It has to be recorded the fair value of the asset that is going to be distributed, measured at the date of declaration. So when that dividend is declared, then that asset has to be marked up to its fair value, and then so that therefore when it's paid out at its fair value. Real quick, 3 dates to know when it comes to paying out dividends. First is the date of declaration or declaration date, which is when the board of directors determines that a dividend will be paid out. So that's a date of declaration. Then there's the date of record, which is when the company determines which owners or which shareholders are entitled to receive that dividend once it's paid. And then the date of payment is when that dividend is actually paid out. We record a liability for that dividend payment on the date of declaration, and then on the date of payment, we reverse the liability and, usually if it's a cash dividend, we credit cash. If it's a property dividend, we credit the property. In the date of record, there's no entry. It's just really a date to determine which shareholders will be entitled to that payment. Let's go over property dividend example. On October 1, the board of directors of Kraft Industries declares a property dividends of 2 million shares of Sing Corporation preferred stock. So Kraft owns stock in Sing Corporation, and that's what they're going to distribute as their dividend. Kraft had purchased the Sing shares in March as an investment, and the book value was $9 million. And the investment shares have a fair value of $5 per share. Now, it's not super clear in my opinion, from this example, but it should say the second bullet point should say on October 1st, the investment shares have a fair value of $5 per share or $10 million, right? So they bought it on 3/1 for $9 million, and then on 10/1, it's worth $10 million. The property dividend is payable to shareholders of record on October 15th and distributed November 1st. Let's go through the entries. October 1 is our declaration date. It's when the board of directors declared this payment. And there's going to be two steps on the declaration date when you're paying out a property dividend. The first one is you have to increase your investment that or the asset that you're going to distribute to its fair value. So in this situation, our investment on March 1, right, was we bought it for $9 million, but on October 1, the date of declaration, it's worth $10 million. So our investment had increased by $1 million. So we're going to debit investment equity securities for $1 million and credit gain on investment for $1 million. Okay, very important that you true it up to the fair value on the date of declaration, not the date of payment, not the date of record. It's the date of declaration is when you true it up to its fair value. The second entry that we're going to do on the declaration date is actually record the liability for the dividend that we're going to pay. Right? So now, in the first step, our investment in equity is actually recorded at $10 million after we record that first entry. So now, same way as we would record any dividend, we're going to debit retained earnings for $10 million because that's going to be the fair value of the investment on date of declaration, and credit property dividends payable. So if you have a cash dividend, you're going to credit cash dividends payable, but we're distributing an asset, so it's property dividend payable. So we're going to credit that amount by $10 million. Date of record, October 15th, there is no entry. It's a non-event for accounting purposes. It's a big event for the legal department because they have to determine which shareholders are entitled to that property dividend. And then November 1st is when we actually pay that dividend. So we're going to reverse our liability. We're going to debit property dividends payable for that $10 million we recorded on October 1st. And now, remember, this is a property dividend, so we're not going to credit cash. We're getting, we're removing that investment off of our books because we're now distributing it to our shareholders. So we're going to credit our investment equity securities for $10 million. Let's do a concept check. So this concept check is not necessarily on property dividends. It's just on what to do in your stockholders equity section. Ellsworth Corporation was organized on January 1, 2027. The firm was authorized to issue 150,000 shares of $1 par common stock. So when it says 150, they were authorized to issue. So this is their authorized number of authorized shares. This is their total number of shares that they can sell over time. But for purposes of what goes into your balance in your stockholders equity section, it's irrelevant. Okay, and the numbers authorized is irrelevant. It will be noted on the shareholders equity section, when it says common shares, 150,000 shares issued and X number, 150,000 shares authorized, and then there's X numbers issued. But as far as the balance in the shareholders equity section, it will not be a factor. During 2027, Ellsworth had the following transactions related to shareholders equity, and the question is, what was the total shareholders equity at the end of 2027? So let's go through these one by one, and that's when I'll read them off. First bullet point is that they issued 20,000 shares of common stock at $7 per share. So you take that 20,000 times 7 is $140,000. So we would record common stock, right, $140,000. This particular problem does not give us the additional information of what was the par value. So but normally we would have that and we would record common stock par value, additional just a paid in capital in excess of par. But this is just a simplified format that we're not recording entries. We're just calculating the total shareholders equity. Second bullet point, issued shares of common stock at $8 per share, which equals $160,000. We reported net income of $100,000. That net income would increase the retained earnings, and the retained earnings flows as part of the shareholders equity section. So we're going to increase that by $100,000. We paid dividends of $50,000. That amount decreases your retained earnings. So we're going to decrease our shareholders equity. And then we purchased 3,000 shares of treasury stock at $10, which is $30,000. And if you watch a video on treasury stock, you'll know that that reduces your shareholders equity section. And so in total, our shareholders equity at the end of the year is $320,000. The answer is C. Okay, now let's talk about stock dividends. Stock dividends are when a corporation distributes additional shares of stock to the current shareholders of the corporation. So in this situation, it's they're distributing their own stock. So I took the example of Apple. If they had investments in Meta, right? Apple bought shares of Meta and then distributed those Meta shares. That's a property dividend. If Apple decides to issue additional shares of Apple stock to its shareholder as a dividend, that is considered to be a stock dividend. Okay, and so what happens when we have a stock dividend? We are going to debit retained earnings, and we're going to credit common stock and paid in capital for some amount. Okay, we'll go through an example in the next slide. But notice, so essentially, I've debit retained earnings and credit common stock and paid in capital, all shareholder equity balances. So when you have a stock dividend, it doesn't affect your assets or your liabilities because your retained earnings goes down, your common stock paid in capital goes up, the net difference is zero. So, but it doesn't affect your assets or liabilities. I want to show you this third bullet point. Shareholders' proportional interest in the company remains unchanged. Let's take a very simple example of what happens with stock dividends. Let's just say we have 3 shareholders. So shareholder number 1, number 2, and number 3. Okay? And let's just say shareholder number 1 owns 200 shares of a company, and then shareholder number 2 owns 300 shares, and shareholder number 3 owns 500 shares. So in total, there's 1,000 shares outstanding. Well, if you just take the pro rata share, that means the shareholder number 1 owns 20% of the company, and then shareholder number 2 owns 30% of the stock, and shareholder number 3 owns 50% of the stock. Okay? Now let's just say the company declared a 10% stock dividend. And that means that however many number of shares I own, I'm going to get additional shares, 10% additional shares. So shareholder number 1 owns 200 shares, they're going to get another 20 shares, right? So in total, they're going to have 220 shares now. Shareholder number 3 owns 300 shares, so they're going to get an additional 30 shares. So now they own 330 shares. And same thing for shareholders number 3, they're going to get, they own 500 shares, they're going to get an additional 50, so now they own 550 shares. So now in total, there's 1,100 shares outstanding, whereas before there was only 1,000. Well, let's look to see what each shareholder's pro rata holdings are, what their ownership percentage is. Well, shareholder number 1, 220 divided by 1,100 is, guess what? Still 20%. Shareholder number 2, 330 divided by 1,100, still 30%, and same thing for shareholder number 3. So why am I going through this example? When a company issues a stock dividend, the shareholders' interest in the company remains unchanged. Their proportional interest remains unchanged. And what happens is that earlier, right, you owned 200, let's just say the overall value of the company is $10 million, okay? That's the overall value of the company. As a 20% shareholder, you have $2 million value. Now, 10% additional shares have been issued. Well, nothing's really happened. The company is still worth $10 million. You still own 20% of it. So your value in this company, your investment, is still $10 million. So a stock dividend might seem really good on paper, but it's not necessarily the truth, because now what happens is that you have the same value in that company, but they've issued a stock. So really, you've received a dividend, but not any sort of additional value. So now, there's something to be said that if you plan to hold those shares over time and and the market price increases, so then you can get more money. But at that point in time, when that stock dividend is issued, it seems like an actual to the shareholder, it seems like, wow, I've received extra stock. But for the company itself, really nothing has really changed. And they've now essentially, quote unquote, paid a dividend without having to do anything really. Nothing within the company has actually changed. So that's just something interesting about stock dividends. When a stock dividend occurs, they can be either a small stock dividend or large stock dividend. It just depends on what size they are. So let's go through that. A small stock dividend is typically a distribution of shares that's less than 20 to 25% of the outstanding shares. And the accounting for it is different than if it was a large stock dividend. And we'll go through an example, but it's recorded at the market value of the shares on the date of declaration. A large stock dividend is when the distribution of shares is more than the 20 to 25%. And in that situation, the distribution is recorded only at the par value, not the market value of the shares on the date of declaration. Now, when you have an exam, whether it's my exam or the CPA exam, it'll be very obvious whether they're not going to give you a question that's a 23% distribution. They'll say it's a 10% distribution, which means it's a small stock dividend, or they'll say it's a 40% distribution, which is a large stock dividend. So it'll be very apparent. Let's go through a small stock dividend example. Kraft has 800,000 shares issued and 600,000 shares outstanding, declares and distributes a 10% common stock dividend when the market value of the $1 par common stock is $15. So we're going to get a distribution of 10%. The question is 10% of what? Because we're given the number of shares issued and the number of shares outstanding. When we do stock dividends, it's always on the number of shares outstanding. So first thing is we need to figure out how many shares are we actually going to issue to our shareholders. So we're going to take the 600,000 shares outstanding times 10% of 60,000. Then we're going to take that 60,000, those 60,000 shares are going to be valued at the market price or the market value because it's $15 per share, because it's a small stock, because it's under the 20 to 25% mark. So that gives us $900,000. And that's going to be our dividend, right? So now we're going to debit retained earnings for that $900,000. Now we have to split that $900,000 between, we're going to issue common stock and paid in capital because it's more than just the par value. So the 60,000 shares times the $1 par value is $60,000, and that's what we're going to credit our common stock for. And then the remaining amount is going to be recorded to paid in capital in excess of par. So these credits are the same that you've seen whenever we issue stock. Same example, same numbers, except now the stock dividend is 50%. So now it's a large stock dividend, and large stock dividend means we only use the par value to record this stock dividend. So now we have, again, how many shares outstanding? 600,000. It's a 50% distribution. So we're going to issue 300,000 new shares, and the par value is $1, so we're going to take those 300,000 new shares times $1 is $300,000, and this is our entry. It's going to be debit to retained earnings for 300,000, and we're going to credit common stock because we always credit common stock for the number of shares times the par value, and then we have no paid in capital in excess of par. So that's how you account for small dividends versus large dividends.